For years, literally years, we waited for Dow Chemical and DuPont to merge and then break the combined entity up into three separate parts based on end markets. Now, regular viewers know that breaking up is fun to do, and it's usually pretty darn bullish, at least on Wall Street. Long ago, we reached a point where big conglomerates stopped getting credit for their scale and diversification. Don't get me wrong. Investors love scale. Big investors, big portfolio managers, they live for it. But only when it's concentrated in a particular industry. That's the logic behind the Dow-DuPont merger/breakup. This is a world where conglomerates are penalized for having too many disparate businesses under one roof. Hence why we keep seeing these high-profile corporate divorces. Money managers prefer to own smaller, more focused companies with fewer moving parts. That's the way that they say, all right, I'm going to get this right. Their stories are easier to understand, make it easier to know what you own, and then they can usually deliver better results once they're freed from the shackles of their parent company. So now that the Dow-DuPont spinoff, which we talked about endlessly on the show, is finally complete, you'd think these newly created stocks would be worth owning otherwise. So why go through all this hassle? First of all, sometimes a company will spin off a division because it's garbage and management wants to cut it loose. Well, I don't think that's the case here. It's one reason you should always approach new spinoffs with caution. Sometimes the parent doesn't want to be with the child. Now, see, for here, the problem of the children of Dow-DuPont, it's different. Unfortunately, each of these businesses is tied to a particular business cycle, which means timing is everything if you're thinking about buying the stocks. At the moment, the timing stinks for these companies, although some have it a lot worse than others. I mean, just as a reminder, you've got the new Dow, which combines the commodity chemical businesses from both of its parents. Now, we used to own Dow Inc. for the charitable trust, but after the dismal quarter they reported last week, we finally had to cut bait. This is a rough time for the commodity chemical space, so even though Dow's paying you to wait with a 5.8% yield, and I understand if you want to hold on to it because of that, a big dividend does not protect you if your stock keeps getting slammed. And I got to tell you, we were tired of waiting, given that we've owned the stock for years, and we didn't want to just be in it for the dividend. Now you got the new DuPont, which is like the new Dow, except for specialty chemicals. But tonight I want to focus on the third one, the one that really seemed very exciting initially to me, Corteva. Corteva Agriscience, CTVA for you home gamers. That's a pure play on ag, on the agricultural business made up of DuPont Crop Protection, DuPont Pioneer, and Dow AgroSciences. Corteva was spun off into the wild at the beginning of June. And while the stock's hanging in there, let's say that's the best performer of the three, it hasn't been a big winner. The stock opened at $26.54 on June 3rd. Now it's trading at $29 and change. Look, I think Corteva is a terrific company, maybe the best that you can own in the ag cycle. Merging Dow and DuPont's agriculture divisions was a brilliant idea, but this might not be the best time to own an ag play. We've had bumper crops over the past couple of years driving down prices. American farmers have been hard hit by the trade war with the Chinese. Even though the government's helping them, that doesn't change the fundamentals of the industry. Throw in some horrific flooding in the Midwest earlier this year, and you can understand why so much of the ag cohort is having such a difficult time. So here's the question. Should you buy Corteva here in the hope that the ag cycle, which so many people like, will ultimately turn? Or does it make more sense to be patient and wait until the stock gives you a better entry point? All right, now let's consider how this works. This is really the nitty-gritty of how stock picking works. Corteva, is it best of breed? Absolutely. It owns some of the best brands in agriculture. They make genetically modified seeds. If you've ever farmed, you know them as Pioneer, Granular, and Brevant. Those are the best. Their products are miracles of modern science. They're more resilient. They produce higher crop yields. They've got seeds that can thrive in just about any environment. Corteva is the second largest player in the seed space behind Bayer, which bought Monsanto a little over a year ago and is having a terrible time. This industry is a slap-happy oligopoly dominated by just 4 companies. Bayer and Corteva alone account for 60% of all U.S. seed sales. I love that concentration. They've also got the best portfolio of crop protection products on earth. Think pesticides, herbicides, fungicides. Millennials, close your ears, I know you hate all those. Between the two sides of the business, Corteva has enough scale to really strong-arm their customers. That stinks if you're trying to run a farm, but it's terrific for a shareholder. By the way, this whole point of the Dow-DuPont merger, what is it? It's, well, rather than being bitter rivals who compete against each other across multiple different end markets, they join forces to dominate those markets. Then they split into 3 separate companies that each have more concentration than either of their parents ever had on their own. Oh, it was such a clever plan. but it took ages and ages to pull off. The initial Dow-DuPont deal was announced in 2015, and by the time they finally finished getting the parts out, terrible. And now Corteva has been spun off. The ag cycle is doing terrible. That's why management forecasts flat sales for 2019, maybe 4% growth in operating earnings before interest, taxes, depreciation, and amortization. Not enough. We know the first quarter results were downright ugly. Organic crop protection sales just up 1%. Organic seed sales declined by 10%. The source of weakness, of course, North America, which was down 22% thanks to the trade war and the awful weather. Now, this stock, Corteva, it reports again on Thursday morning, and while there's not a lot of enthusiasm about the quarter, management's been pretty bullish about the second half of the year. As Corteva prepared for a spinoff, they told us the first half would be ugly, but the second half would make up for that, and more so. Then a little over, let's say, a month ago, Corteva announced a $1 billion buyback equal to 4.6% of the share count, and they also declared a dividend, 1.8% yield. However, lately investors have gotten somewhat skeptical here. At first, the bull case seemed obvious. Thanks to its scale and pricing power, Corteva would be able to grow faster than its underlying end markets, maybe 100 or 200 basis points faster. Plus, since the Dow-DuPont merger, they've already cut $1.2 billion in costs from the business that became this company. They think they can cut out another $500 million thanks to productivity improvements over the next 5 years. So you put it all together, you know what? I like it. Unfortunately, those numbers aren't supposed to come together until next year. After the spin, a bunch of analysts rolled out bullish coverage in Corteva, but it's all about next year. Over the past month, it's become clear that 2019 could be brutal for this industry. So if you want to stick around for 2020, you might end up being a glutton for punishment. Remember how there are 4 big genetically modified seed companies? One of them is BASF. German chemical company hit us with an extremely negative pre-announcement earlier this month. Since then, it's become a lot harder to focus on a potential turn in 2020. So we got to ask, is 2019 weakness baked in? That's the question. Right now, this thing trades at 20 times earnings. Pretty reasonable for a company that might be able to generate 16% long-term earnings growth, assuming they can meet the estimates. That's not expensive, although it could be a lot cheaper. So the bottom line on a stock that I liked for a long time, but obviously because the cycle's been tough, I'm not so sure about. I hope they will deliver a better than feared quarter when it reports on Thursday. But hope should never be part of the equation. As much as I do like the company, and it is extremely well run, the sector's having a very rough time. So if you want to buy Corteva, you know what? I think you should wait. I'm betting you get a better entry point than you're getting right now. And I sure as heck wished I had never heard of the whole Dow-DuPont merger. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.